Hi guys, welcome to another episode of What Stock, where I tell you what stock I'm buying next and why. In the last few years, I've attended a number of engineering expos, and in that time, I've seen 3D printing go from something that's really cool to something that every single manufacturer is going to need to implement. This industry is blowing up, and it's on the cusp of seeing widespread adoption. It's a great place to invest your money if you can find a winning company. Before shooting this video, I looked at the 10 companies that were driving innovation and scooping up market share, far surpassing their competitors. From those 10, I've shortlisted my top 3 based on their product offering, their technical and fundamental analysis, and their projected future growth. At face value, all 3 companies are great buys, and I could probably put money in all 3, and there's a reasonable chance that I'll do pretty well out of it. But as the law of statistics dictates, one of these companies is going to outperform the others. And off the back of my due diligence, it's become painfully clear that one of them is better than the rest. But before I run you through the numbers, please take the time to like the video and subscribe to the channel if you want to see more of this stuff. Now, the first thing you want to do before you buy a company is figure out how much debt it has and its ability to pay off the interest on that debt to its creditors. In layman's terms, a company that has no debt can't go bankrupt and won't keep us awake at night out of fear that it can't pay the bills. At a glance, we can see that Proto Labs and Stratasys have no debt. But Materialise is pretty highly leveraged and is going to really struggle to pay off the interest, let alone the debt, back to its creditors. This is a yellow flag. The second thing you want to do after you see how much a company owes is to see how much it owns, but more specifically, how much it owns versus its short-term liabilities. Having good liquidity means a company should be able to weather any unforeseen market downturns and effectively keep the lights on when it's dark outside. Now you can see that all of these companies are reasonably asset rich, but Proto Labs just inches ahead in terms of how long it can keep those lights on. Now the third thing you want to look at is the projected bottom line growth of the company, because a company that isn't growing is stagnating. Look, I get it. In the short term, all of these companies are expected to suffer some kind of loss in earnings, with Proto Labs losing the least. In the midterm, Stratasys and Materialise are forecasted to see triple-digit growth. In the long term, it's predicted that all 3 will continue to grow and see double-digit growth consistently each year. Now, if you were to base your investment decision purely on the educated guesses of a few Wall Street analysts, you'd go, yeah, Materialise. Why else would I put my money anywhere else? However, we're smarter than the average retail investor because we know that Materialise is burdened with debt. And not just burdened, it's struggling to pay down the interest. And this could significantly impact that projected growth journey. It's also important when looking at the analyst's estimate to look back and take some lessons from the history book of its previous growth. You can see almost immediately that those triple-digit growth expectations of Stratasys are totally alien to what it's done in the past. So you need to ask yourself, what's Wall Street smoking? Expecting it to grow significantly more than it's ever grown, and it's been around for years. Just something to think about when you're doing your own analysis. The next thing you want to look at is the management team. Why do Mercedes keep winning the Formula One? Is it the car or is it Lewis Hamilton? It doesn't matter how good the technology is if the wrong person is driving the car, they don't know the roadmap, and they've never driven in those weather conditions. You're still going to lose the race. Return on indicators act as a great proxy for assessing the management's effectiveness in deploying capital. In a rapidly growing market where the landscape is shifting all the time and management teams need to adapt, it can be really challenging to have really strong return on indicators. Having said that, when you look at these numbers, you can see there's one company that just gets where this market is going. Now, the last thing we want to do is look at the margins. Now, a good rule of thumb is if the margins are razor thin, your interest needs to be razor thin. As investors, we like big, beefy profit margins. Nothing gets us more excited. When we look at these numbers, we get a great insight into the percentage of the sale that Proto Labs can reinvest back into the growth of the company. So out of the 3 that we've shortlisted, it's pretty clear cut that Protolabs has all the winning attributes of a company that we want to invest in a fast growing industry. They are perfectly suited to outperform their competitors. They have the right management team, the right bank balance, and they're headed in the right direction. But are they trading at a good price? One of the hardest things to do in high growth industries is to get an idea of what a reasonable price to pay is. We can't expect a low PE ratio or a PEG lower than 1 or a DCF that falls in line with a minimal acceptable rate of return. The best thing you can do is compare the cost of one high growth company versus another high growth company. At the time of this recording, Protolabs is trading at $112.17 and has a positive EPS of $2.30. We can see that we get a lot more bang for our buck on the earnings yield, and that compared to Stratasys and Materialise, is pretty much slap bang in the middle on its price to book and price to sales ratio. Despite the fact that Protolabs is clearly the superior company, we're not currently paying a premium for it, which means that the market might not be aware of the significance it has in shaping the market. That presents a fantastic buying opportunity. When we look at the insider activity over the past 6 months, we can see that actually they're pretty bullish on that stock, particularly at $112 a share, which tells me, yeah, this could be a great time to enter a position. In short, Protolabs is a great company trading at a very reasonable price at the beginning of what could be one of the best growth stories that ever existed. Thanks for taking the time to watch my video. If you have any questions, comments, or feedback, leave them below. I love hearing from you and having conversations with you guys. Watch out for my next video. Happy investing!